All right, let's get right into it. We've all heard the first rule of investing 1,000 times. Don't put all your eggs in one basket. It's simple, right? But what if I told you that the basket you think you have is actually much, much smaller than you realize? Today, we're going to tear down some of the biggest myths about diversification and rebuild our understanding from scratch, focusing on the one thing that actually counts. So check this out. A recent study found that a whopping 78% of regular investors, people just like us, believe their portfolio is properly diversified. I mean, they've spread their money out, bought different stocks, different funds, and they feel pretty safe about it. And that right there is the million-dollar question, isn't it? Because feeling safe and actually being safe when the market decides to go haywire, well, those are two totally different things. This brings us to something I like to call the diversification paradox. It's this tricky illusion of safety that so many of us fall for, and honestly, it can lead to some pretty devastating results. I want you to think back to March of 2020. Remember that feeling? Millions of people were just watching in absolute horror as their portfolios, which they thought were diversified, all took a nosedive at the exact same time. All that variety they thought they owned offered almost zero protection when it mattered most. So why did that happen? Well, it's because owning, say, a dozen different tech stocks isn't real diversification. And here's the really sneaky part. A lot of different mutual funds that look totally separate, are often holding the exact same big-name stocks. So what you end up with is this kind of surface-level variety that's really just hiding a massive amount of concentrated risk underneath. Okay, so if just counting up your stocks and funds doesn't work, what's the answer? Well, the secret, the real mathematical heart of true diversification, is a concept called correlation. And believe me, this changes everything. To put it simply, the correlation coefficient is just a number that tells you how two different investments move in relation to each other. A +1 means they're basically identical twins. When one goes up, the other goes up. A -1 means they're polar opposites. So here's the key takeaway. For real, powerful diversification, you want that number to be as low as you can possibly get it. Think of it like this. Assets with high correlation, like two tech stocks, are like puppets tied to the same strings. They pretty much move together, which, as you can guess, really hurts your diversification. But low correlation assets, like stocks and, say, treasury bonds, they're dancing to their own beat. They move independently. And that independence is exactly what gives your portfolio real protection. And this isn't just theory. Look at the actual data. Between 2020 and 2024, the S&P 500 and the NASDAQ had a correlation of 0.92. That's incredibly high. They were basically the same investment. Even US stocks and international stocks, which people think are so different, move together with a correlation of 0.83. This is exactly why just buying a bunch of different stock funds isn't the answer. Now compare that to this. This is where the magic really happens. The correlation between stocks and gold, just 0.12. And get this, between stocks and treasury bonds, it was actually negative. That means they don't just move differently, they often move in opposite directions. They act like a powerful shock absorber for your portfolio when stocks are falling. So now that we're armed with this crucial knowledge about correlation, how do we actually go about building a portfolio that can, withstand the inevitable storms? Well, we need to find the right building blocks. Here are some of the heavy hitters, the key asset classes that have historically shown very low correlation to the stock market. We're talking about things like government bonds, real estate, commodities like gold, and even some alternative strategies. These aren't just slightly different flavors of stocks. They're fundamentally different investments that are driven by completely different forces in the economy. Okay, let's bring this all together and see what the impact looks like in the real world. We're going to compare a typical diversified all-stock portfolio against a truly diversified portfolio that's built specifically with low correlation in mind. And wow, the difference is just staggering. Look at this. The all-stock portfolio has a super high internal correlation of 0.82, which leads to that gut-wrenching volatility of around 16%. But the truly diversified portfolio? By adding in those low correlation assets, it slashes its internal correlation down to just 0.38 and drops its expected volatility all the way down to about 9%. Let's pause on that for a second. By simply focusing on correlation instead of just counting stocks, you could potentially cut your portfolio's expected volatility by almost half, 44%. That is the difference between panicking during a market downturn and actually being able to sleep at night. All right, this all sounds great,
But how do you actually do this? How do you put it into practice? Let's give you a simple, powerful toolkit you can use right away. It really boils down to 3 steps. First, you have to look beyond the name of your mutual fund or ETF and really understand what's inside it. Second, you have to actively seek out and add some of those uncorrelated assets we talked about. And third, and this is a game changer, use the amazing free tools out there like Portfolio Visualizer or Morningstar's X-Ray to run a diagnostic and see what your portfolio's true risk actually is. At the end of the day, this is the philosophy that we really need to embrace. True diversification isn't about trying to be a genius who can predict what's going to happen next. No, it's about being humble enough to admit that we can't, and then preparing our portfolio for a whole range of possibilities. So I'll leave you with this question to really think about. After everything we've just gone through, what hidden connections, what secret high correlations might be lurking inside your own portfolio, just waiting for the next market storm to show up? It's probably time to find out.